What if I told you there's a company right now growing its revenue at 547% year over year, and it's already locked in contracts worth over $20 billion with Microsoft and Meta? Welcome back to Smart Stock Sam, and today we're answering the question everyone's been asking. Is Nebius Group, ticker NBIS, still a buy after this massive bullish run? And where does the price go from here? We're going through their full year 2025 results, breaking down the technicals and giving you the exact levels to watch. But here is what most people are completely missing, and it might change how you look at this entire AI build-out story. So let's start with where things stand right now, because volatile doesn't even begin to cover it. Nebius is currently sitting in what analysts classify as a strong buy regime, but underneath that surface, this company is essentially brute forcing its way into AI dominance. On one side of the scale, you have explosive revenue and a contract backlog stretching all the way out to 2031. On the other, a net loss of $249 million in a single quarter. This is a high-conviction bet on the physical backbone of artificial intelligence. And right now, the market is starting to ask a very uncomfortable question. How long can they keep bleeding money before it catches up with them? The growth numbers, though, they are almost impossible to believe. In 2024, Nebius pulled in around $91 million in total revenue. By 2025, that number exploded to $529.8 million, a 479% increase for the full year. In the fourth quarter alone, revenue hit $227 million, which is up 547% from the same period the year before. But here's the twist. Wall Street was expecting $247 million. They missed. And in the world of hyper-growth stocks, even a small miss can shake investor confidence fast. What happens to a company when the expectations finally outrun the reality? That's exactly where the cost of that growth comes in. Nebius brought in $227 million in Q4, but after factoring in cost of revenue and massive operating expenses, they posted a net loss of $249.6 million. Compare that to the $122 million they lost in the same quarter last year. And you can see the burn is not just continuing, it is accelerating. Even their adjusted EBITDA missed analyst expectations. They are essentially trading today's profits for tomorrow's dominance. Which brings up the obvious question, where is all of this money actually going? Simple answer, hardware. In Q4 alone, Nebius spent $2.06 billion on capital expenditures, a 392% increase year over year. Think about that. Their investment is outpacing their current revenue by nearly 10 to 1. They're buying GPUs by the thousands, building out cooling infrastructure, locking up power capacity. This is what it actually costs to compete with the biggest names on Earth in AI compute. It is an all-in, high-stakes wager that demand for AI infrastructure will not just remain strong, but accelerate. And could they possibly be wrong about that? In this environment, it almost seems unthinkable. But here's what makes this different from a typical money-burning growth story. Despite that eye-watering burn rate, Nebius is sitting on a fortress balance sheet. $3.68 billion in cash and cash equivalents as of December 31st. That is a massive liquidity cushion. It gives them the runway they need to keep building without immediately diluting shareholders. For investors, that cash pile isn't just a safety net. It's the difference between a calculated risk and a reckless one. And they are not building all of this on speculation. Nebius has already locked in a contract backlog exceeding $20 billion. The centerpiece is a multi-year deal with Microsoft worth between $17 and $19 billion, running through 2031. They've also secured agreements with Meta platforms and other major hyperscalers. The infrastructure being built right now is essentially pre-sold. The question is no longer, will customers show up? The question is, can Nebius build fast enough to fulfill what they've already promised? Now, they're also making a move that most people haven't talked about enough. On February 10th, Nebius acquired Tavily for approximately $275 million. Tavily specializes in agentic search. Think of it as the intelligence layer that sits directly on top of the raw compute. By moving up the stack from pure GPU rental to software and search capabilities, Nebius is playing a longer game. They don't just want to power AI, they want to be embedded in how AI thinks and retrieves information. That's called customer stickiness, and it's the kind of move that separates infrastructure companies from AI ecosystem companies. So what does management actually think 2026 looks like? They're targeting an annualized revenue run rate of $7 to $9 billion by end of 2026. To hit that, they need power, and they are gunning for 3 gigawatts of contracted power capacity. They've also brought in Deloitte and Touche as their auditor, signaling a maturation in corporate governance. This company is transitioning from aggressive growth mode startup to legitimate institutional-grade operator, and that shift matters. Now let's talk about what the charts are actually telling us. The stock is currently trading at $98.01, sitting comfortably above all key moving averages, the 5-day, the 20-day, and the 200-day. That kind of positioning typically signals strong institutional accumulation. Big money is buying dips and holding. But there is a warning light on the dashboard that we cannot ignore. Momentum is running very, very hot. The RSI is sitting at 66, bullish but manageable. The StochRSI, however, is screaming at 88.82. In plain terms, the stock is overbought in the short term. The MACD is still in buy territory, but these oscillators are warning of near-term exhaustion. A pullback is not a question of if, it's a question of when and how deep. But here is where it gets really interesting. There is a potential short squeeze building beneath the surface. Short interest sits above 17% of the float, and borrow fees have just spiked from 0.41% to 2.34%, meaning it's becoming significantly more expensive for bears to hold their short positions. With a short volume ratio of 55%, a clean break above $100 could trigger a rapid chain reaction as short sellers are forced to cover. That kind of move can be explosive and fast. And the options market is adding fuel to that fire. The put-call ratio is sitting at 0.35, heavily tilted toward the bulls. But there is a literal wall at $100, where 6,900 call contracts are stacked up as technical resistance. On the downside, 4,000-plus put contracts are forming a floor around $90. If Nebius breaks through that $100 wall with conviction, there's very little overhead resistance until we reach 110. Before I give my analysis on trading setup, I have to give you an important reminder. Nothing in this video constitutes financial advice. Equity analysis presented here on Smart Stock Sam are for educational and informational purposes only. Always do your own research and consult a licensed financial professional before making any investment decisions. Investing involves real risk, including the potential loss of principal. So how do you actually play this? The strategy is simple. Buy the dip, not the spike. Given those overbought signals, chasing the stock at $98 is not the move. Instead, look to accumulate on pullbacks into the $95 to $96 zone. That aligns with the 200-day moving average and key pivot support. Analyst consensus targets sit between $145 and $150, which represents roughly 50% upside from current levels. But discipline matters. If price breaks and closes below $93.28, the bullish setup is technically invalidated, and stepping aside is the right call. Now, the final verdict. Nebius is a high beta play on the physical build-out of artificial intelligence. On one side, explosive growth, a $20 billion backlog, a fortress balance sheet, and a company that's already pre-sold what it hasn't even built yet. On the other, widening losses, execution risk, and a stock that may need to breathe before its next leg higher. If you can stomach the volatility, and the ride will not be smooth, The long-term thesis here is as compelling as anything in the AI space right now. Accumulate on dips, watch that $100 breakout level, and keep your stop below $93.28. If you found value in this analysis, do give me a thumbs up, subscribe, and hit the bell icon so you can get the opportunity before a crowd arrives. As always, stay disciplined, protect your capital, and I'll see you in the next one.